Thank you, Peter. Good morning, everybody. And thank you for the invitation to participate in this discussion. I'm for our topic, Net Zero Transition, a Credible Path to Zero Emissions. We've got a panel representing a bank, an asset manager, and a pension fund. So welcome to the three of you. And if I could just identify each of you as Elsa Palanza from Barclays, Karlijn van Lierop from BMO at Global Asset Management, and Louise Aagaard Jensen, Senior ESG Manager at PKE, the Danish Pension Fund. So perhaps maybe you could take a moment to talk a little bit about yourselves, just a quick intro, yourself and your organization. Should we do that, Elsa?
Sure. Good morning, everyone. Really nice to be here. As Jamie said, I'm Elsa Palanza. I'm the Global Head of Sustainability and ESG at Barclays. And it's perhaps an odd fit that we have this big global bank sitting here talking about impact, but that's exactly why we need to be here, is to focus on that. So delighted to be here. Thank you.
Hi, everyone. Great to be here today. My name is Karlijn van Lierop. Great to meet in person again and to see so many familiar faces. I work at BMO Global Asset Management as a Director of Responsible Investment. I joined January, so pretty recently. Before I worked at MN as head of the Responsible Investment team and therefore worked as a sustainability professional.
Yeah, and hello everyone. My name is Louise Ovajensen and I'm a Senior ESG Manager at PKA, a Danish pension fund. We are one of the largest pension funds in Denmark. We have around 350,000 members within the health sector in Denmark. And around 54 billion euros in asset under management. And PKA has been working with investing responsibly for some decades now, but it has especially accelerated since 2010, where we started where we made our first, or PKA made its first green investment. And then from there, it has been pretty much been accelerating, and it's a journey that has very much been should be credited to the members of PKA that has been demanding this.
Thank you, Louise. So net zero seems to have moved to the top of everybody's list of priorities in sustainability, and I think there's broad agreement globally that we need to collectively decarbonize the world's economic system and keep the planet from heating by more than 1.5 degrees above pre-industrial levels. And actually, the momentum is breathtaking. The Net Zero Asset Managers Initiative was set up in December 2020, and in 1 year had gathered 250 members, representing $58 trillion in AUM, which is about a third of all managed assets. And that group of 58 trillion was part of a larger coalition, so not just asset managers, but also insurance companies and banks and others, chaired by Mark Carney, who's the former governor of the central banks of Canada and the UK. Mark Carney announced in Glasgow in November that the members of the Glasgow Financial Alliance for Net Zero, so GFANZ, had committed $130 trillion to net zero. What does this number actually mean? Does this mean we have a pot of $130 trillion to spend on renewable energy? Because that seems like more than enough to get the job done. But that's not what it means. What it really means is that financial institutions managing that amount of assets have now set themselves on a path toward net zero. So what does that path look like in practice? Let's find out. So let me ask you the first question. I want to be really concrete about net zero. So what does net zero mean? What does it mean to have a net zero investment portfolio? And does that mean protecting the investment portfolio from climate change, or does it mean protecting the climate from the activities of the companies invested in, or both? Karlijn?
I think it's both. It's very much, of course, about protecting your portfolios and mitigating climate risk, but I think it's also very much about protecting the environment. I think in our work, we think it's very important to start with the principle of making real economy emission reductions and make real economy impact. And you asked about, what is it that we could do, to get started and to take tangible steps. I think there are like 3 steps you could imagine taking. The first one very much is about measuring. So to what extent is your current portfolio or holdings already aligned with a 1.5 trajectory? From there on, you should, of course, think about targets, and not only long-term targets and the net zero targets, but also intermediate milestones, so short, medium, and long-term, very smart targets. And there, actually, the work starts. So then it's, of course, about decarbonization. And there are like many tools that you could use. I'm sure we will dive into the divest or engagement dilemma. And of course, you could divest, but we think it's far more powerful to engage, to change those companies and to move them to a net zero strategy. So engaging the tool of voting and climate resolutions, and of course, impact investing and actually invest in climate solutions are, I think, like very tangible tools and steps you could take to get started.
So the part where you're protecting the climate is where you're either making positive investments in carbon suppression or pushing companies through through engagement to get to lower emissions.
Exactly.
Yeah. So that's the part where you're protecting the climate. Okay.
Yeah.
All right. I want to come back to that because you've mentioned a couple of interesting things. But Louise, so from your perspective, what does that mean?
Yeah, well, it's definitely also both, and I think it also means to participate in the global collaborative effort for us to reach the Paris Agreement and the objectives of the Paris Agreement, and that everyone has in the entire society has a responsibility for us to be able to make that. So in that sense, it both means it's both a matter of protecting our investments on our portfolio, as much as it is also a matter of contributing to the objectives of the Paris Agreement. So I would say both, and this is also why back in 2021, PKA committed to the IIGCC's Paris-aligned investment initiative and also the Net Zero Asset Owner Alliance. And also in Denmark, we have an initiative started by the Danish government called the Danish-led Climate Reporting Initiative. And all three basically have the same objectives of how do we get started on this journey to become CO2 neutral by 2050. At PKA, it's always been our philosophy that we believe return and responsibility can go hand in hand. And again, this is something that has been required by our members. They're really keen on this agenda. So it's something that's been required for them already back in the 80s, and then it's just been accelerating. So as I mentioned before, PKA started in 2010 with making its first green investment. And then building on this experience, we have set several targets within, like climate-related targets for green investments, carbon reduction, and so on since then. And I would say our approach is very much similar to what you also mentioned before. And I think I can also get a little bit back to that. We kind of have 3 pillars in our net zero strategy that we're working on at the moment since we committed last year. Setting 2025 targets for climate solutions, for CO2 reductions, and also setting targets for engagements with companies, trying to push them to commit as well to becoming CO2 neutral by 2050. Otherwise, it would be hard for us to have a carbon neutral portfolio if there's no companies to invest in. So, yeah.
Well, we'll talk later about what happens when you have trouble finding them, or when you have them. What do you do with assembling the companies that you do invest in? But I think one of the interesting things about this morning, all the speakers this morning have talked about net zero and sustainability as a team sport. There's nobody doing this alone. It's all the aggregation. It's the aggregated efforts. It's the collaboration. It's the intercommunication. And I want to ask you one thing, though. As I mentioned, the Net Zero Asset Managers Alliance, a third of all managed assets just within a year signed up. There's an Asset Owners Alliance as well, much smaller. Is it harder for an asset owner like a pension fund to sign up to net zero than an asset manager? Or do you think it's a question of asset managers are closer to the mechanics of it and the asset owners less so? I mean, do you have a thought on that, either of you?
Actually, not. I was not aware that there was less asset owners that had signed up for the initiatives on that
It's a
side.
smaller number.
Yeah, okay. But at least in Denmark, I think all our peers have signed up. so
Well, that's Denmark for you.
but as I mentioned, right now we are working with more than one framework because we're both committed to the Net Zero Asset Owner Alliance and the Paris Aligned Investment Initiative, and there are also other initiatives out there, science-based targets and so on. So we're looking at right now how do we just have the best possible toolbox to actually work with this. But I'm not sure why less asset owners should have signed up. For us, it was just a clear commitment. PK has been working on this agenda for a long time, so when our CEO came and said we should sign up, we were ready for it.
Karlijn, am I making this up, or have you noticed, do you agree with Louise that it looks equal between asset owners and asset managers?
Yeah,
And if there is a
I
difference?
think the commitment for both initiatives is huge. And of course, you can look into the numbers and sort of compare assets under management. But I think it's really about the power of those initiatives and making them work and live up to those commitments. I mean, signing up to an initiative is one thing, but to actually decarbonize or have like a sense-making strategy, that's quite something else.
Yeah.
And I think, we should definitely not sort of compete in terms of initiatives and continue setting up more and more initiatives. We really, should collaborate, join forces. There's so much technicality that we need, number crunching, data science, research that we need. So I really think it's also about collaboration and joining forces.
So Elsa, let me ask you about the banks, because I come from the asset management. I have an asset management background, and impact investing largely focuses on investing, but the banks have more money. And it's the banks, actually, that are doing the incremental funding, whether it's for renewable energy or for oil and gas. So I'd be interested in your perspective on banks. What's the bank's perspective? What's a bank's perspective on net zero?
Yeah, I think this is really important, and I would say if there's sort of one thesis we should walk away from today with, it's this idea that capital flows, we all have to be interchanged and interconnected with one another. We're running kind of a relay race, and if we don't get early stage investment capital going in the right direction, the banks are these big behemoths facilitating capital markets, and that's hugely important because then you can channel all of that capital markets activity in a productive direction, or like you said, it can all be continued to channel towards traditional growth industries from the previous century, which, as we all know, is predicated on fossil fuels and isn't going to do any of us any good when we start talking about climate. So, as you mentioned, just before COP, we had this big glaring hole in the Net Zero Alliance world, which was that there was no Net Zero Alliance for banks. And so that was really critical that got put together, and thanks to Mark Carney's leadership and to the very helpful deadline that was COP26, it really started to get everyone focused on this idea that we needed this coalition. And the reason why you have a coalition is not just because it's good to, state that you're part of this, but actually that you set up a series of rules and guidelines for what we all agree to do. So if you look at the Net Zero Banking Alliance, there's the commitment, which is one page, and then there's the practical guidance, which is like, 60 pages. I can't remember how many there are, but it gets into the detail of what it is exactly that we've signed up to do. So in Barclays' case, we had actually, over 2 years ago, had set an ambition to be a net zero bank. We were one of the first major banks to do so, and that's great. And I think happily we've seen a race to the top. Most global banks now have set that in motion. But if we get practical about what that actually means, we knew we had to make a concrete commitment beyond just that ambition, and that was that we committed to align our entire financing portfolio to the Paris Agreement, to the goals and the timelines of the Paris Agreement. So that means, very practically, systematically moving sector by sector through our portfolio, looking at Paris-aligned, science-based pathways, understanding how those individual sectors need to decarbonize over time, and then comparing our own portfolio to that and setting very
Your lending portfolio.
Our lending portfolio.
Yeah.
Our lending portfolio and our capital markets portfolio.
Capital
and that was
markets as
actually
well.
important.
Okay,
Barclays,
interesting.
we knew that if we didn't allocate our capital markets in the right direction too. Balance sheet is important, and of course it is large for a big global bank, but if you don't start talking about all the capital markets activity going on, then you're really missing a huge part of the global economy. So we allocated 33% of capital markets activity, understanding that we don't have full control of that value chain. That being said, I think we're seeing that conversation move, and it'll be interesting to see how we start accounting for capital markets going forward.
Do you do the same thing that the asset managers do, which is to pressure the companies to change the way they operate their businesses? Because in the engagement process, an asset manager will sit down with management and say, what are you doing about net zero? How are you moving toward a science-based strategy? Do you do the same thing with your lending and capital markets clients?
We of course have a different kind of relationship because we don't own them. It's a little bit more of an arm's length engagement. But I think that's partly why, yes, the short answer is yes, we do have, as advisory services, we have a chance to actually engage with these clients. Our bankers have built up relationships with them for decades. So it's an opportunity to have that kind of conversation. And then as a coalition, when you start seeing all global banks moving in this direction, that's really, really powerful and helpful because we're all sending the heft of the capital markets activity in the right direction. So yes, I think we see ourselves as stewards of that transition and an opportunity to lean in, support our clients, and there's opportunity there, by the way. If we all do this the right way, as you've said, there's a chance to actually have an opportunity for real revenue generation, helping the same clients who have traditionally operated in one way transition their business models and send them off in a totally different direction.
I'm so glad to see banks now such a visible part of GFANS, because I worked for 19 years with an asset manager owned by a bank that is the biggest lender to fossil fuels in the world. And so I remember just being conscious that we can rearrange our investment portfolios, but really you have to, the incremental capital that is funding new activity has to be managed in a particular way. And I think so. I'm really glad to see the banks much more front and center in this conversation. I want to come back to the investment management, though. I sort of want to picture, and you've sort of touched on this both, what does the portfolio actually look like? How much is divesting from high emitters? How much is investing in low emitters? How much is investing in transitioning companies? How much is proactive investments that might actually be lowering negative emissions? Are you using offsets? Is somebody using offsets in this whole process? Karlijn?
No, we would not start there for sure. I mean, very much understand if companies use offsets given certain technologies, but it would not be an advice to start there as an asset manager for sure. I think before you really start with implementing a strategy and use specific components in a strategy, you should start with clarity around what it is that you want to accomplish as an asset owner or an investor. So to have clear goals and clear investment beliefs. I mean, it's quite something else if you just want to mitigate risk, or if you want to simply decarbonize your portfolio, or if you really want to contribute to the energy transition. So
people could be doing either one or both. I mean,
but coming from a risk perspective is something else than trying to accelerate the energy transition. The latter will probably focus more on impact investing. And the first one would maybe start with divesting or decarbonizing or use specific benchmarks. So I think starting with clear investment beliefs could probably bring you to a more coherent strategy. Yeah. And from there on, you can start with top-down objectives. Again, short, medium, long-term targets. Really dive into your portfolio and come up with bottom-up analysis for all asset classes. As you just explained, looking at your holdings and assess to what extent those holdings are in line with the sector trajectories or IEA or IPCC scenarios. And then you can start, looking at your investment strategy, maybe use specific benchmarks that are now also out there, and indeed consider if impact investing, would be one of the building blocks that would suit your strategy. Yeah.
But you're saying the different asset owners effectively will come to different conclusions about how much is protecting their portfolio and how much is proactive, depending on what their investment beliefs are.
Yeah, I think asset owners or pension funds, will have like different cultures or identities. And some have like very high ambition in terms of net zero or climate and really want to embrace this and like put a lot of time and energy into become decarbonized really fast. And others feel like it's more about mitigating risk and protecting their portfolios.
Yeah. So let's ask a pension fund about that.
For sure. It's very much the same as you're saying. And also from my experience at working at PKA, and in the Danish pension sector, it's definitely a matter of also what are the priorities of the members that really creates a culture in the organizations and dictate the investments that we make and the strategy we choose. So there, I can just see, like, depending on what kind of member groups there are, you see the different levels of ambitions within this for the Danish pension funds. And just to get back to also how do we do it? So as I mentioned before, we have more or less set 3 pillars of our net zero strategy, which is, as we have mentioned earlier, which is investing more in green investments, and it's reducing the portfolio CO2 emissions, and it's to exercise active ownership with with companies to try to push them as well. Just to touch a bit on what that means to us. So the first one, with increasing our investments in green investments, PK has set a target now for 2025 of having 6.7 billion euros in green investments.
What's that as a percentage?
Sorry?
What's that as a percentage?
So it would be, we had a target in percentage. For 2020, we wanted to have 10% of our asset under management in green investments. And we made that target in 2020, and then that was equivalent to 5 billion. So now we set a new target, but we decided to have it absolute, in an absolute number. So we had 6.7 billion euros, 50 billion Danish kroners. So it would be more or less, it would be, 11, 12% at that time. It all depends on how does our asset under management grow as well with the. So we decided to have an absolute number, but it should be more or less that. When it comes to the reducing the portfolio CO2 emissions, we began last year with a working group that sat down and looked at how we could approach this, and we found that to begin with we could measure our carbon emissions of listed equity, corporate bonds, and real estates. So those three asset classes. And then set a target for 2025 of reducing those 3 asset classes with 29%. So that's our first part of our strategy when it comes to actively reducing the portfolio CO2 emissions. And then going forward now, the next phase for our strategy is to implement more asset classes. So this year we're focusing on our infrastructure investments. And then it's also a matter of setting a 2030 target, which is also the next challenge. And I also just want to say that on top of that, some of the initiatives that we are taking to reach these targets it's a combination of things. It's a combination of having, of course, finding low carbon investments, tilted mandates. It's a matter of having strategic divestments, because what we found was also that from divesting from one company, we could already reduce a large amount. But there's like some low-hanging fruits in the beginning when you build this strategy. And then also, of course, the whole aspect of engaging with companies, vote at general assemblies for the companies, and try to push them in the right direction. PKA is very active in the Climate Action 100+, the global initiative where we are engaging with 167 companies globally. that are the largest carbon emitting companies.
So you're making this all sound quite doable. No, you really do. I mean,
it's a long way.
You don't sound like you're struggling, but I know there's a cost to this whole thing. It is not straightforward. I think banks probably have the hardest time with this, as I think about it. I mean, so Louise and Karlijn are talking about rearranging portfolios and tilting portfolios and adding this and subtracting this, but when you're a bank, are we talking about cutting out whole areas of your business and trying to replace it with brand new stuff? I mean, what is that like? Next, I want to hear from you what the cost is, but I think for the banks in particular, it's interesting.
Yeah.
When I think of a bank that's got a business lending to oil companies so they can discover new oil fields, that has to stop. That's all that revenue goes away. So tell us a little bit about that.
Yeah, well, I think this is where the concept of the transition to a low-carbon economy, which is the most commonly used concept over and over and over again, actually has legs. And we have to talk about what that really actually means. Because if we say we're making this transition, ultimately we're all dependent on the real economy moving. If the real economy doesn't actually shift, if we don't dramatically reimagine our entire economy, we will never get there. We're never going to hit our climate goals, which are shared on a planetary level, obviously, as we know. We have a global carbon budget. So for banks, you're right. I think part of it is just mechanics. We often do, when you're talking about big capital activity, it's often done in syndication. So unless you're all aligned, whatever banks happen to be in that particular syndicate.
Back to the team sport.
Exactly. A lot of folks have said, oh, well, surely you can just set up terms to your loan agreement or to your bond agreement. And yes, in theory, that sounds great, except for the fact that often these move incredibly quickly. The time that you have to put together a deal is sometimes days once it runs through all of your governance process. And unless you have sort of predetermined things, I think for green products, we have a lot more control and the ability to actually say, here's the KPIs. We've worked really closely with some of our clients. That's really fun and exciting to actually set something up like that, where you actually can set metrics that you know are going to steer that business in the right direction. But when you're talking about typical capital, unless you just have very little control of the ability to actually dictate the terms of that particular agreement. So, to your question, yes, I mean, I think fundamentally, if you aren't willing to actually say, what does this mean for our engagement? We're not dropping companies wholesale. I think this goes to this question. We've touched on it a few times, but this issue of divestment versus engagement. And obviously, banks don't divest because we're not investors, we're facilitators. But I do think there is more than enough capital out in the global economy. If we all wanted to just look pure from the get-go and walk away from everything, there would be tons of capital out there ready to facilitate that. So I think we're seeing this happening. A lot of people are shorting coal at the moment because we still need it. Obviously, we all know what's going on with the global energy economy. And so there's a real question there about actually how are we responsible stewards and how do you do that most effectively? Is it just about making yourself look good? Or is it actually about turning the economy in the right direction and being real responsible stewards of that? So we have walked away from deals. I don't publicize that because it's about making sure that your own governance is standing up to the test and that there's real integrity there. Yeah. But yes, we have walked away from deals that could have been really big because they did not hit our own goals and our own benchmarks and our own rules for ourselves. We have very specific rules about the way that we're engaging. But I would just double down on the fact it's not just lip service, that the amount of opportunity in the green economy is so big that it's really a race to the top about how we can all capture more and more of that. We've all set big green finance targets. And I think there's a clamoring, and what we really have to do now is make sure that the rules around green finance are as clear as possible, so that there's no greenwashing risk.
I have another question, but first I want to check and see if there's anybody in the audience that has a question, or Peter, if you have anybody online.
My mic is on, I think, yes. And the question from one of the audience abroad is, isn't there a risk that decarbonizing the portfolio cuts funding to companies that need in the most to invest in cleaner technology?
Yeah, I think this is exactly this question. of walking away versus engagement. And I don't, it'd be interesting to compare notes on how we all do this, but I think we're going to need the scale and capacity of a lot of the, if we're just, let's talk about energy for a second, because I think that's the clearest example here. But a lot of the big global energy companies who are investing trillions right now in renewable energy technology, how do we make sure that we're funneling finance in that direction and helping them turn the corner, walking away from fossil fuels and actually reimagining the scale and capacity and technological know-how and all the rest that they already have in order to make that happen? I think we saw a real tragedy, and I'm sure everyone in this room knows how long it took for renewables to get cost competitive with fossil fuels. I don't think we need to do that again with any other economy. We know how to short circuit that with things like agricultural technology, et cetera. So I think, yes, the short answer is we have to make sure we're funneling transition finance, but you have to have really clear rules set up around what that actually looks like, so it's not just helping to facilitate the same.
Karlijn, what's BMO think about transition finance?
Yeah, I very much agree with what you just pointed out. I think we need to encourage and push those companies to reinvent themselves and to come up with new future-proof strategies. And if you just walk away and die fast, and there will not be a signal for those companies to accelerate their thinking about what will be a strategy that will be low carbon or net zero. So, and there can be a combination, and sometimes it's good that some pension funds or asset owners make those bold statements, because that can also sort of underline the sense of urgency for the companies that they really need to change and be quicker and accelerate.
So
but I think, if the sense of urgency is there, it's really about the conversation of investors and those companies. How can they change? What are the, how should they allocate their capex? And not just indeed lip service, and not just coming up with net zero statements that are too far out or too vague, or just applying to tiny bits of their business, but really across their business.
Well, so let's take the example of an oil company. So do you hang on to oil companies because you can give them that urgency through your management of that relationship?
Yeah, I think we're also, just as was just mentioned by Louise, we're a very active participant in Climate Action 100+, and we very much believe in the power of engagement. So the global cooperation and the global power that we have to push oil and gas companies to reinvent themselves and to come up with strategies, that will be applicable in a net zero economy is really important. And I think we should push for that.
Yeah, interesting. Question in the room? Yes, here in front. Can we bring a microphone?
Hi, my name is Pauline Wink. I'm from For Impact. My question to you is, what do you consider the biggest barriers to move more money into the impact investing? Is it regulatory? Is it reporting? Is it opportunities? So how would you perceive your companies to be able to do more, and also the entire industry to be able to do more?
Louise, can you take that one?
Yeah, I think for sure. I think first of all, one thing that we are looking very much forward to and working with is the EU taxonomy coming up on sustainable finance. We have for a long time been discussing internally how do we do with you can invest in an infrastructure project today that you would consider green, and then half a year later maybe it would not be considered green anymore. So we really need some standardization on what activities are considered green. So that's one thing that we're very much looking forward to. The only thing is we're investing in the whole world, so it would be great if it was a global standard and not just one within the EU. So that's one thing. And other things that, of course, return is important. We do have a fiduciary duty to make sure that we earn a return for our beneficiaries. So, but we do also believe that it is possible for those two things to go hand in hand. And so it's regulatory. We need standardization. To some extent, we also need data. But that's hopefully coming, and you see that data is becoming better and better. But that's also something that yeah,
Thanks for
we're not in a perfect place yet, but or have a perfect solution. But I definitely think it's great to see that, as you mentioned in the beginning, we're getting momentum. People are daring to take steps, and then we learn as we go. And we have also made investments in the past where we thought we could consider green, and then now with the EU taxonomy coming in, we have drawn them back and not considering them one of our green investments anymore because it's not fitting with the new standardization coming. So it is really a steep learning curve. But I think the most important thing is to get started. But it is, of course, challenging.
Peter, do you have another question?
Yeah, I have another question. Thank you. Not from the audience, but for myself. You talked about investment, target investing. You talk about die invested. You talk about engagement. But one of the things you said was that the role of the members is very important. Because what I experienced the last years is that the boards of pension funds, especially pension funds, I'm sorry, that's my world, are aware that they want to pay a good pension and want to pay indexation, and especially in the Netherlands, indexation is a lost word. So could it be that when the members are more forcing the board to change their asset management and to change the choices they make, that will help to change the world?
Members. Oh, member engagement. That's an interesting one. Karlijn, do you have a view?
Yeah, I think consulting members and the ultimate beneficiaries as a pension fund is absolutely key. And I think we mentioned before that sort of the identity of the culture of a pension fund should not be underestimated. So it's really important to reach out to your beneficiaries and to be aware, indeed, what is their perspective on impact investing, or what's their perspective on climate, but also could there be like specific themes that could be very important, like health in the pension fund that you've been working for so long. So I think being aware of those themes and preferences is absolutely important to be aware of. Yeah, absolutely.
And can it be helpful to make the members more active?
Yeah, I think so. I mean,
and who should do that? Who should do so?
And I think maybe just to add to it, I think actually the member groups, it's quite interesting because you can definitely tell that they do differ from one pension fund to another. For example, just since we are from the health sector, one of the first things we decided to have zero tolerance for was tobacco companies. But that might not be the first thing a pension fund from another sector will be the first thing that they tackle, because maybe they do not have so strong opinions about smoking. So it does matter who your members are as a pension fund.
So before you ask your next question, with the very little time we have left, I would love to get a final thought from each of you. Just a thought on this topic for this audience to take away. Elsa?
Well, I think we've been talking about decarbonizing our own portfolios, and that's obviously a critical part when you're looking at net zero. But I do think what we haven't brought in, which our keynote speaker earlier did bring in, is the role of nature, which we cannot forget. And ultimately, if the meta theme here of today is to think about the SDGs, there's a reason why this is a circle, and they're all interconnected. And so one thought is just the fact that we have to make sure that we're keeping the human part of this. We didn't get into the just transition, but that's of course a huge part of this conversation about vulnerable communities and workforces and how you bring them all along, how you link that to the decarbonization of our global economy, and then of course the role of nature as our first and best defender against climate change, and how we make sure that we're supporting that and bringing that together. And then I guess I'd link that to what I said earlier, which is just that we have this global handoff to the question earlier about how we grow this. You have to have early stage capital, growing nascent industries and nascent businesses to then get handed off to grow them further. And the capital markets are ready and waiting and to crowd in with a lot of capital. So I feel a lot of hope there.
That's great. Very interesting.
yeah, I think really good remarks by Elsa. We should not forget about biodiversity, and also talking about just transition, about the inequity that comes with climate change, like so many emerging or frontier economies that are so vulnerable. And we really need climate adaptation to make those countries more resilient. To wrap up, I think maybe 3 thoughts. One, use your portfolios, really look at your portfolios and how you can steer them towards net zero. Second, use your voice and use your rights, being a shareholder. And the third one, very important today, of course, with this audience, invest with impact. There's so many opportunities, and sometimes there's also some myth-busting needed, I guess. Of course, it's about risk and return, but we need to invest in emerging economies, and of course, we need to look at cost and track record and all that. But I think it would be really good if asset owners would dare to do a little bit more in terms of impact investing.
Great. Louisa, a final thought.
Yeah, of course. Yeah, and I think I also have two final remarks. I think for investors in general to succeed with this with the agenda and for the Paris Agreement to succeed, we need the entire society to contribute all together, and that means everyone from investors, asset owners, asset managers, the banks, politicians, but lawmakers, consultancies, and so on. But it also means the companies and the consumers. So we have to work towards that. We cannot invest in portfolios that are not with a part of the society. So we definitely need the consumers as well to help us with this agenda. And then one other point I wanted to make is also I would just encourage every investors to participate in these global initiatives, which is bringing asset owners and asset managers together to find pathways of how we can accomplish the objectives of the Paris Agreement. And that means that's initiatives such as GFANS, as we talked about earlier, the Paris Aligned Investment Initiative, and Net Zero Asset Owner Alliance, and the Asset Manager Alliance. What is it? Net Zero Asset Manager Alliance. Thanks. Basically, even though there are many challenges along the way and there is no perfect solution yet, we must get started, and then we have to learn as we go, and we might set targets along the way, and then we get new methodologies coming in and new data, and then we have to adjust along the way. But we have to get started because we can simply not afford to wait any longer if we want to succeed, for the Paris Agreement to succeed.
That's great. There's a lot more to say on net zero, but no more time to say it in. So I'm going to hand things back over to you, Peter. But
Thank you very much. We will now have a coffee break, but before we go to the coffee, I ask an applause for this panel.